Brent crude has now moved above $100 a barrel, and that is sending a shockwave through global markets. But this is not just about the headline price of oil. The bigger story is that disruption around the Strait of Hormuz is forcing investors to reprice inflation risk, supply chain costs, and the odds of Federal Reserve easing. Reuters reported Brent settling at $100.46 on March 12th as markets reacted to tanker attacks and rising Middle East tensions. A lot of people still think this is just a Middle East headline, but markets are treating it as a direct earnings problem. Roughly 1/5 of the world's oil normally moves through Hormuz, so any serious disruption there raises energy costs, transportation costs, and input costs across the economy. That is why this is not just a geopolitical story, it is a margin story. On March 12th, the S&P 500 fell about 1.5% as investors started pricing in the inflation and profit impact of the oil shock. Washington has not officially locked in a Jones Act waiver, so that part should be stated carefully. The more accurate wording is that the U.S. administration is considering a temporary waiver to ease domestic fuel pressures. That matters because it shows policymakers are worried about supply bottlenecks and energy costs. But it also tells you the system is under real strain. Now take that into the Fed story. It is true that this oil shock is making early rate cuts harder to justify. But saying September is now certain would be too strong. A more accurate version is that some banks, including Goldman Sachs, have pushed their first cut expectations back, while the broader market is becoming less confident that cuts will come quickly. The main takeaway is not that September is locked in, it is that the bar for early easing just got higher. Tomorrow's PCE report is still important, but the timing matters. The BEA says the next release is on March 13, 2026, and it is the January 2026 Personal Income and Outlays report. That means this week's March oil spike will not be directly reflected in tomorrow's number. What markets will actually be watching is whether inflation was already sticky before the oil shock hit. If January PCE comes in firm, investors may combine that with today's energy shock and push the higher for longer narrative even harder. The private credit story also needs to be framed carefully. There is real stress building in parts of that market, and Reuters reported renewed concern after restrictions tied to redemptions and fund pressures. But calling it a full collapse or systemic break would still be too aggressive based on what is publicly confirmed right now. A more accurate line is that higher rates and rising operating costs are increasing stress in parts of private credit, especially where borrowers are heavily leveraged. And Adobe is no longer a tomorrow event. Adobe reported earnings after the market closed today. Reuters reported fiscal first-quarter revenue of $640 billion ahead of expectations, but the stock fell more than 7% after the company announced that CEO Shantanu Narayan plans to step down once a successor is named. So the cleaner way to frame it is this: Adobe already reported, and despite strong numbers, the market reacted more to the leadership transition and ongoing AI strategy concerns. So the real market story right now comes down to three things: energy, inflation, and balance sheet stress. Watch margins. Watch cash flow. Watch leverage. That is where the damage shows up first. This isn't financial advice. Focus on the numbers, not the noise. I'm Wilson, and I'll see you tomorrow.